Yeah, really, depending on which Fed speaker you're listening to at any moment, it's either jobs that are most important or sticky inflation that's most important. So, from your perspective, what's the greater force at the moment?
Well, I think it is a bit of a toss-up. I think Fed officials aren't quite sure what they want to do, but my inclination is to believe that they'll pass on a December rate cut, that there will be another pause. They'll reconsider at the beginning of next year. As Fed Chair Jerome Powell recently said, over the past year, they've already lowered the federal funds rate by 150 basis points, and maybe it's time to just give it a rest and see how it all plays out in the economy, and also wait for some better data to understand where the economy actually is. But right now, I think they still need to be concerned about inflation, and obviously in the labor market, there's some issues, but I'm not sure that those issues can be solved by lowering interest rates.
So you mentioned that you see a December rate cut coming, but are there some risks to that expectation as well? Because, as you say, we've been a bit data poor recently. Is the market prepared for the risk of a pause in December and maybe that pause being extended for some time?
I think it wouldn't be much of a surprise, because I think Fed Chair Powell already signaled that in his press conference a couple of weeks ago. And the market did sell off on that, but then regain its footing, mostly because the earnings story is still very good. There's a lot of concerns about the economy, but I think the economy is actually has proven and will continue to prove remarkably resilient. And we see that in earnings. They say that the stock market is not the economy, but earnings are the economy. So the stock market is very much influenced by what's going on in the economy, as reflected in earnings. And the earnings picture in the first quarter was surprisingly good, same in the second quarter. And now we're getting kind of the tail end of the third quarter earnings reports, and they also look amazingly good. Instead of a 6.5% increase year over year in earnings, it's coming in at 14% on a year over year basis. That's what's really driving the market.
Yeah, that's an important point to remember, that things aren't bad, and normally if the Fed's cutting rates, you would say, well, the economy looks as if it's in need of support. But you point out there's already been quite a lot of easing so far. Does the U.S. economy look like it needs support?
Not to me. As a matter of fact, last year when the Fed started cutting rates, I said that might be a mistake. Because the economy was stronger than they were thinking. The labor market at the time certainly looked stronger than they were thinking, and that proved to be right. But they went ahead. They didn't listen to me. They cut the Fed funds rate by 100 basis points for September through December of last year. And guess what? The bond yield went the other way. Bond yields rose 100 basis points, so they more than offsetting the easing of the federal funds rate. And it kind of looks like the same thing's happening right now. They cut by 25 basis points, and then 25 again. So we've got 50 basis points here in September, October, and yet the bond yield is kind of sticky around 4%. Mortgages are kind of sticky around 6.5%. So the Fed's got to appreciate that. The Fed funds rate, while they can control that, they can't control the rest of the yield curve, and the rest of the yield curve is sort of saying no mas. Let's not go. We don't really need it.
Yeah, and where do you feel the Fed funds rate is positioned vis-a-vis the neutral rate? Do you think we're getting close?
Well, you're asking the wrong guy, because I think the neutral rate is an illusion. It's maybe even a delusion. There is no such thing. If we can't measure it, and if we could measure it, I think everybody agrees it wouldn't necessarily be fixed. It's not like some constant in mathematics. I think we only really know it after the fact, and what seems to be factually true is the labor market is tight, even with its problems. The unemployment rate is 4.3%. That's the last reading. And inflation is still 100 basis points above the 2% inflation target. But it probably will drop to 2% over the next 6 months once the tariff shock is over. So we're kind of at nirvana. We're kind of where we should be. which leads me to conclude then, so why are we lowering interest rates? Why is the Fed lowering interest rates, and why is the bond market resisting it? So I think the bond yield at 4.5%, the federal funds rate at 3.5 to 4% is where the economy continues to thrive.
All right, so you're painting a picture of relentless optimism here, and the saying goes that the only thing that kills bull markets is a recession.
Yeah.
So, from what you're saying, we're nowhere near close to one of those. So, that in mind, you've updated your price target for the S&P by year end. Can you unpack that a little bit more for us?
Yeah, I'm looking for the S&P 500 to get to 7,000 by the end of the year. It's been a volatile year. I wrote a couple of times that I reserve the right to change my opinion as often as the president changes his mind about tariffs and other matters. I did start out the year at 7,000, then with the tariffs, I gave in some, but I remained bullish relative to where the market was, and I'm back at 7,000. Well, I mean, it's only 2% away. It's a day or two away in terms of getting there. I'm using 7,700 by the end of next year. That would be a 10% increase. So I think it's still very much a bull market. And look, I think the optimistic view so far so good. I started out back in 2020 arguing that this decade could turn out to be the roaring 2020s. And so far so good. And guess what? I don't even think it's going to end badly the way the 1920s ended.
I was about to say, let's hope it's not followed by the 2030s mirroring the 1930s. But let's move on from that idea. We've also got reason to have a little bit of optimism as well with the US government apparently on the cusp of reopening. Would you expect to see any meaningful bounce to asset prices off the back of that?
I think there already has been. I think the market had, rebounded somewhat on Friday. It was still a down day, and then it had a very good Monday on the perception that Congress would open the government, and we seem to be on course for that. So I think the market's already pretty much discounted that. I think the market right now is kind of wondering what happens if the Supreme Court later this year or early next year determines that Trump's tariffs are unconstitutional. Then what happens? That could be a messy situation. I guess the administration would have to refund the tariffs, and then the bond market could have an adverse reaction, because right now, if we keep the tariffs in place, the government's going to bring in another $350 billion over on a 12-month basis, and that could disappear, and some of it might have to be refunded if the court rules against the administration, which it very well might. So that will probably happen at the beginning of next year. For now, I think we're sort of in year-end rally mode, Santa Claus mode, and 2-3% increase from here would get us to 7,000, and that would be a great way to end the year.
In the back of my mind, I can hear viewers saying, ask about AI bubble risk, but we're going to get to that in a little while.
Sure.
But first of all, the question around the tariff risk that you were just discussing there, is that part of the reason you've changed and lifted your outlook for the price of gold as well into 2026?
Well, I've never had an opinion on gold because I'm an old-fashioned strategist. I need something to value. I need some income, some dividends, some coupons, but the gold doesn't provide any of that. But when the gold price rose above 2,000 to a new record high last year, I did write that I thought that might be the beginning of a major breakout to the upside, and I thought it was mostly related to a simple fact, and that is Russia invaded Ukraine. The United States froze the international reserves of the Russians, as of the Europeans, and central banks of countries that don't share our views started accumulating gold. So I thought that was basically what was driving it. But along the way, I think another story here is Chinese investors lost a lot of money in the property market. They got whipsawed in the stock market. I think they've kind of stumbled onto gold as a good way to increase their net worth. And so I think that's also driving the price of gold up. When it crossed 3,000 at the beginning of the year, I kind of looked at the charts and I thought I could see this thing getting to 4,000 by the end of the year. And as you know, we got there a few weeks ago. And I'm using 5,000 by the end of next year and 10,000 by the end of the decade, which is where I also see the S&P 500.
10,000 by the end of the decade. I mean, is that, I'm wondering if that part of the reason for that is that, gold is priced in US dollars. We're seeing quite a lot of dollar weakness at the moment. And, Stephen Jen of the dollar smile theory has been the latest to weigh in on this. He sees the trend for the US weak and getting weaker. What's your view for the greenback?
Well, I guess I continue to be a contrarian. I don't try to be a contrary just to be contrary, but that seems to be where I've been heading. And I think gold had just a correction, kind of a 8 to 10% correction. A lot of people are using DXY, which is the dollar index, and it's about 57% weighted in the euro. So the DXY is basically the euro. And I don't have any particular reason to get excited about the euro as an alternative to the dollar. But I think what a lot of people are missing is stable coin. We had in July, the Congress passed and the president signed the Genius Act, as it's called, and it kind of legitimized stable coins, and stable coins are just digital dollars that are backed by liquid assets, by treasury bills, and I think a lot of them will be in dollars. I think a lot of them will be backed by treasury bills, and I think it'll be used. I think it'll be one of the reasons that the dollar will actually be surprisingly strong. Already, a lot of emerging markets are latching on to stablecoin as a good way to deal with the fact that their financial systems just aren't that developed.